Hi everyone, welcome to chapter 7. This chapter is about depreciation and assets, still moving down the balance sheet. So I'm going to do a few examples. I'm going to do it in an Excel spreadsheet. If you want to follow along, you can find these problems in your book, but I also have them in the spreadsheet. When I'm finished, I'll upload the spreadsheet so you have it for reference. So the first one is E73. And it talks about a company that purchases land, building, and equipment all together. We don't record them all together. We want to record them in their separate accounts, land, building, and equipment, for various reasons. But one of the reasons is we depreciate those things on different bases, different ways. We definitely do not depreciate land because land doesn't go away. It doesn't get used up. Well, one could argue that, but it doesn't go away. So how do we do that? If we have a single purchase price of 600,000, we allocate those costs based on the estimated fair values of those things. So it's telling us the estimated fair value of the land is 175,000, the building is 455,000, and the equipment is 70,000. So it has a total estimated fair value of 700,000. And you'll see that down here where I put the estimated fair value of the land, the building, and the equipment, and it totals $7,000. So what do we do here? Well, here we want to allocate. We want to take the 175,000 and we want to divide it by the total, the 700,000. And that gives us a percentage of the total that belongs to that piece of land. So we want to take 175,000 and divide it by 700,000. That's 25%. We want to do the same thing for the building. So building, 455 out of the total of 700,000 gives us 65% value for the building. And then the equipment, divide the 70,000 divided by the 700,000 gives us 10%. And you'll notice that the three of those add up to 100%. So the basket purchase was 600,000. And that's true. We want to put that on all these lines. Oops. Sorry. So how much do we want to record of that 6,000 for land? 25% of that. So 600,000 times 25%. And we want to do the same thing for the building. 600,000 times 25%. 600,000 times 10% for the equipment. So now we know what we can record for land, building, and equipment for a total of 600,000. We use the fair value to allocate it, fair market value. So brief exercise 7-9. We have a restaurant that purchased furniture on September 1st for $45,000. Residual value at the end of the 10-year service life is expected to be $6,000. Residual value means when we get through using it, we can sell it for $6,000. So we want to only expense the $45,000 less the $6,000 because we don't want to expense the $6,000 that we will not be using. The formula to calculate annual depreciation is cost minus residual value divided by estimated life. In this instance, it's 45,000 minus 6,000. So plus 45,000 minus 6,000. Oops, not 60. Divided by 10 years. So we're going to take 39,000 divided by 10 years. That's $39,000 per year. Well, you'll notice they purchased it on September 1st, so they didn't have it a whole year. You take that annual depreciation and you divide it by 12 months. So we're going to take this 3,900 and we're going to divide it by 12 months. That gives me an amount per month times the number of months, which is September, October, November, and December. So it's 4 months. So my depreciation for 2021 is $325 times 4 months, or $1,300. Again, my annual depreciation divided by 12 months, and we don't really have to do this because we already know it's $3,900 a year. So for 2022, it's $3,900, but we could also do the annual depreciation divided by 12 months, put in the number of months, 12, and multiply it back out, 325 times 12. Either way works, but you had already calculated the annual amount. And for 2022, they had it the whole year. They had it from January 1st to December 31st. Okay? E711. So Speedy Delivery Company purchases a delivery van for $36,000. They estimate at the end of its 4-year service life, the van will be worth $6,400. So after they finish using it, they can sell it for $6,400. During the 4-year period, they expect to drive it 148,000 miles. We want to calculate annual depreciation for the first 2 years using 3 different methods: straight line, double declining balance, and activity based. And it also tells us how many actual miles were driven in year 1 and year 2. We will need that for activity based. So straight line, we want to take the cost minus the residual value divided by the useful life. That's straight line. That means we're allocating it equally over the service life. So cost minus residual value is $36,000 minus $6,400, I think it was. Yep, $6,400. And the useful life was 4 years. So my annual depreciation would be $29,600 divided by 4, or $7,400 per year. And of course, you could break that down into months as well. Double declining balance is an accelerated method. What you want to remember about double declining balance is it's double the straight line rate. So the straight line rate is 4 years, so it's 1 over 4. 25%. So if you take 1 divided by 4, it's 25% per year under straight line, or straight line rate. So be careful here. A lot of students just double the straight line amount. You can't do that. You have to double the straight line rate. So in year 1, the beginning book value is cost minus accumulated depreciation. That's book value. So our beginning book value is $36,000. Notice we're not taking into account the residual value. We're going to take the book value. The depreciation rate is 0.25 times 2, or 50%. So my depreciation rate, or my depreciation expense, is $36,000 times 50%, or $18,000 the first year. At the end of the year, my accumulated depreciation is $18,000. because that's all I've depreciated it. My book value is my $36,000 cost minus my accumulated depreciation of $18,000, or $18,000 as book value. Year 2, I start with my ending book value from year 1, which is $18,000. I multiply it times the same rate, 50%. So 18,000 times 50% gives me 9,000. My end of year amount in my accumulated depreciation account is the 18,000 from year 1 plus the 9,000 for year 2. That gives me 27,000. My book value at the end of year 2 is 36,000 minus my accumulated depreciation of 27,000, or 9,000. And then I would go on to year 3 and I'd start with a beginning book value of 9,000 times 50%, and so on and so forth. I would stop depreciating when I reached the $6,400 residual life. It's important to remember here that you're doing twice the straight line rate, and you're multiplying it times the book value. And book value is equal to cost minus accumulated depreciation. It's important to understand what book value is because you're going to use that in a later calculation. Activity-based says we're going to depreciate it based on how many miles we use it. So in year 1, we used it 40,000 in year 1 and 46,000 in year 2. So we're going to put 40,000 here, 40,000 miles, 46,000 here. So year 1 and year 2. What rate do I use? Well, I want to get my depreciable cost, which is 36,000 minus my residual value of 6,400. And I want to divide that by the total number of miles I estimate that I'm going to drive at, 148,000. That's 20 cents a mile. And I'll use that all throughout the life of the equipment. So my depreciation expense is 40,000 miles times 20 cents. Accumulated depreciation at the end of year 1 is 8,000. My book value is my 36,000 original cost minus my accumulated depreciation, or 28,000. Year 2, my depreciation expense is 46,000 times 20 cents a mile. And my accumulated depreciation is from last year plus this year, or 17,200. My book value is 36,000 minus my accumulated depreciation, or 18,800. So to recap, for straight line depreciation, you take your cost minus your residual value and divide by your useful life. For double declining balance, this is the only one you do not use the residual value. You take your book value times double your straight line rate. Come up with a new book value at the end of year 1 and use that new book value at the end of year 1 to calculate year 2. Activity-based, simply based on the number of miles. Total number of miles, let me restate that. It would be the depreciable cost, which is 36,000 minus 64,000 divided by the total number of miles. And that gives me a rate per mile. I think I might have said minus 64,000. I meant minus 6,400. So those are the three basic rates. We will focus on straight line, but you should know how to do these others as well because there are problems that have those in it. Amortization. This is when you have an intangible asset like a purchase or like a patent. Intangible assets have no physical presence, but they're still assets nonetheless. So when you expense an intangible asset, it's called amortization, not depreciation. But it's the same theory. So we're going to do some journal entries about this company that purchased a patent on January 1st for $237,000. The remaining legal life of that patent is 20 years, but the company estimates it will be useful for only 6 more years. So the 6 years is what we're going to use to expense it. And then in January of 23, they had some other things going on. Let's just do it piece by piece. So we're asked to record the purchase in 2021, the amortization in 2021, amortization in 2022, and then legal fees, and we'll come back to that. Let's do one at a time. When we purchase the patent, it's just like anything else. It goes into the asset account called patent as a debit for $237,000. And you credit cash $237,000. That was the purchase. And we'll keep track of this down here in this patent account. So $237,000 is the cost of our patent. We want to amortize it at the end of 2021. So we've had it a full year. We want to take this cost of the patent and amortize it. So this is going to be called amortization expense. And we're going to debit that account, and we're actually going to just credit the patent account. We don't use an accumulated amortization or a contra account for intangible assets. We reduce it completely because once it's gone, it's gone. So how much is our amortization expense? Well, we said it was a cost of $237,000 over 6 years. So plus $237,000 divided by 6 gives us $39,000 per year, $39,500 per year. At the end of 2022, same thing. Amortization expense and patent. Same amount. Because we're doing straight line. So we're just going to divide it over the years. So what happened in 2023? In January, the company incurred legal fees of $57,000 in successfully, and that's important, defending a patent infringement suit. It did not change the company's estimated useful life. So now we had to pay legal fees to defend our patent. We need to add that to the cost of the patent. That's a debit of $57,000. And we'll credit cash because we had to pay cash for it. And let me post these things. So let's post this $39,500 reducing, $39,500 reducing the patent. So that's this one and this one. We're going to increase the patent by $57,000. So now our patent stands at $215,000. When we do the amortization for December 31st, 2023, it's going to change. We are now added some more to the patent that we need to depreciate or amortize. It said the company's estimate of useful life has not changed. It was 6 years. Do we divide by 6? Well, no, because we only have 4 more years left. We've already depreciated 2 of those years. So we're going to take the new balance here, the $215,000, and divide it over the remaining 4 years. Gives us $53,750 per year. And we're going to post that to the patent account. That brings the balance down to $161,250. The thing to remember about amortization is you have an account called amortization expense. Oops, and I spelled this wrong. I just realized this. And I spelled it wrong all the way through. Amortization. That's terrible. Sorry about that. There. You have an account called amortization expense that you debit, and you credit the intangible, the patent account. Okay, one more example. And this is for when you sell a piece of equipment that's not fully depreciated. If you sell it at a gain, you have to pay taxes or report the gain. If you sell it at a loss, you have to report the loss. So here's the problem. E717. Abbott Landscaping purchased a tractor at a cost of $42,000 and sold it 3 years later for $21,600. Do they have a gain or a loss? Well, we don't know. We need to look at the facts. They recorded depreciation using the straight line method, a 5-year service life with $3,000 in residual value. They included the tractor in the equipment account. So the account we'll use is equipment. We're asked to first record the sale. So let's record the sale first. Whoops. We're asked to record the sale, not the purchase. Sorry. So here we want to put in this information. So we need some information before we can go any further. Well, we know the tractor cost $42,000. You have to calculate how much depreciation they've already taken on this piece of equipment. So my depreciation would be $42,000 minus $3,000 divided by 5 years, right? Isn't that what we said we were going to do? It says they recorded depreciation using straight line 5-year service life with a $3,000 residual value. So $42,000 minus $3,000 divided by 5 years gives us $7,800 per year. They did this for 3 years. So their total accumulated depreciation is $23,400. They sold it for $21,600. The cost of the equipment was $42,000. The accumulated depreciation was $23,400. And so our book value is $42,000 minus $23,400. Now, the way you determine gain or loss is you compare the sale amount to the book value. So my sale amount was $21,600 and my book value was $18,600. So I actually have a gain. $21,600 minus $18,600 gives me a $3,000 gain. All of that is to calculate, these things that we have to do is to calculate whether we have a gain or loss. Now we need to actually record the sale. Journal entry for the sale. Cash. We got cash, right? We got $21,600 in cash. We need to close out these two accounts. So our accumulated depreciation has $23,400 credit balance. To make it zero, I need to debit it $23,400. My equipment account has a $42,000 debit balance. To make it zero, I need to credit it $42,000. Let me just skip a line here. Equipment, credit $42,000. Now, my debits, and I'm going to move the screen down just a tad. My debits total, and if you look down here in the bar, you can see what the debits total, $45,000. My credits total $42,000. Oh, my debits need to equal my credits. The difference is a $3,000 credit, which is a gain on sale of equipment. So a gain is like a revenue, so you're going to credit it. Now my debits equal my credits. Requirement 2 says assume it was sold for $13,600 instead of $21,600. So the sale amount down here was $13,600. My cost is still $42,000. My equipment depreciation, accumulated depreciation, is $23,400. My book value is $42,000 minus $23,400, or $18,600. Now, if I take my sale minus my book value, I have a loss of $5,000. Journal entry. Cash. I'm getting $13,600 here. I still need to close out my accumulated depreciation account by debiting it $23,400. I still need to close my equipment account by crediting it $42,000. But I have a loss. If you look at the total here, is $37,000. My total credit is $42,000. I need a debit of $5,000. This is called loss on sale of equipment. It's like an expense, so it would be a debit. And my formatting's off on that, so let's format. Let's fix the formatting. There we go. So the important thing to remember when you sell a piece of equipment is you have to calculate what the book value of the equipment is. In order to calculate the book value, you have to know the depreciation that was taken that's sitting in the accumulated depreciation account. The best thing for you to do is draw these two T accounts and fill them out before you even start anything else. Then you compare the book value to the sales price to determine. You take the sales price minus the book value. That tells you whether you have a gain or loss. That's all I have for you. I hope this helps. Have a great week. I'll talk to you next week.